One area of concern in this economy is private credit. We've talked about private credit probably the last 2 or 3 weeks now in the daily financial news, talking about subprime auto lenders and fraud and things of that nature. But I just looked up a stat that says private credit might be as big as 1.3 trillion, and some folks say all the way up to 4 trillion. So
Yeah.
this is an important market, often called shadow banking. We're going to talk about this with the one and only Anna Kelly. How you doing, Anna?
I'm doing great. This is such an important topic and something that I've been watching, concerned about for a couple of years as we started to see, just to push into private credit. And what really got me even thinking about it, honestly, was I listened to an interview with a former head he was one of the FOMC governors, Tom
Mm-hmm.
Honig, and he was
Yep.
also over the banking system. And
Yeah.
so he has a really good lens to what's going on. And he was asked, what is your, biggest concern? And he said, really, it's the derivative market and the credit markets, the private markets that the bank and the Fed really have no control over, no purview over, no lens into how big it is. And what his concern was is that in the time period where we saw failures of several banks, so this was back, Silicon Valley Bank, Signature Bank, et cetera, and the Fed having to come in and, the Treasury with a rescue program for the banks, we saw that when banks basically have assets that get devalued because interest rates go up, which drives up the risk premium that, investors demand to hold those assets. And that goes for just about anything commercial real estate, bonds, and in those cases. Essentially, eventually, these if assets get called, or if there's demands on those deposits and your collateral isn't worth as much, then you become insolvent. And so we saw banks basically becoming insolvent because they had demand that they had to meet, and they had to mark to market security. So they had to recognize the real value as of today, rather than hold to maturity securities, which are like, hey, we're going to value it at whatever it was when we bought it, and we're not going to take an increase or a decrease on that value. And so what he basically said was, this is like a category 4 hurricane for banks. But what we also don't realize is that even though we call some private credit private, a lot of private lenders actually take loans from banks themselves. And we saw that. And a lot of people don't realize that. You just think, oh, it's private, it's not banks, the banks are safe. But what he essentially was saying in this interview, and I'm sorry, I can't remember what show it was on, was that, banks are at risk for default of their bonds, which typically are their safe assets that they're holding, but also commercial real estate. And so we've talked a lot about on this channel kind of the coming refinance wave of all this commercial real estate, that also, because of treasuries being high, because of interest rates being high, the demand for higher returns for the risk of owning commercial real estate is such that they demand a higher return than what they get in treasuries. And so if you demand a higher rate of return for the same income that it's producing, you're going to pay a lot less for that asset to get that return on your cash. And so he's like, the next shoe is all these same banks that have these bonds that are at risk are now holding commercial real estate, which is going to come due for refinance. And this was just starting to happen, and we've started to see some of that. But he said, then you've got private credit that's actually companies who are actually borrowing money from these same banks. And some of the larger banks are going to have some risk of basically this triple whammy. So I think it's important to understand just at the outset of the conversation that while we talk about private credit, there is a real risk to banks if they've lent to these companies and then private credit starts to dry up. And so it's a very complicated topic. And to make it kind of soup to nuts, just simple. And this is a way oversimplification. But when banks start to dry up the amount of money that they'll lend and the type of things that they'll lend on and their risk appetite, which definitely started happening a couple of years ago because of these concerns about the assets on their books, they need to be making higher quality loans to companies that have a track record, essentially. And so if you don't have a track record, or you're investing in something that's a short-term note where you're betting on high appreciation very quickly, those assets are a little more risky. So doing, I'll just say probably the riskiest is like lending to a tech company who has no income to support the debt. So those types of companies, and we know the big ones like NVIDIA, right? But there's lots and lots and lots of tech companies or AI companies on the verge of being the best company, or even small drug companies on the verge of maybe making something that's going to produce income over time. But in the years where they don't have really they have proof of concept, but they don't have income to pay the debt, these banks will lend maybe so much, but then they're going to have to go to private credit, private investors, private funds that are saying, hey, we're willing to fund you because we think you've got something. And they basically lend them enough that the interest payments start to kind of come out of that debt. And that's all fine and good, Michael, when the economy is doing well. But what starts to happen is as the economy starts to falter, and as some of these companies run out of money and they're still not generating income, they can no longer afford the payments on those private loans. And so the interest rates are pretty high because of the risk on private credit. And so what happens is, these private loans, similar to, fix and flip kind of bridge loans on commercial real estate, if you will, that are 2-year loans. And if you're real good, maybe they'll give you a 1-year extension. So you got 2 to 3 years. Longest term, these loans are typically about 5 years. And so what we saw, similar with real estate, is 5-6 years ago, interest rates were fairly low. Companies borrowed a whole lot of money. But what they're up now against is an economy that's no longer expanding, that's contracted clearly, that's come close to a trough, or what we call recession, but just kind of rolling in and out, but not growing enough to get enough people paying in money and generating enough income to do that debt. And we are at a major wall of refinance required in both the public and the private debt markets, both banks and non-bank institutions, what we call private credit or private lending. And you've got a mass of refinances that are needed coming due. And if they're not making their payment today, they're not going to be able to refinance at the same loan value of what they already own. And so therefore, many of these companies just go bankruptcy, poof, overnight. So we saw, this used car lender and auto parts lender that on the books supposedly had all these assets, and seemingly overnight, they're like, we're worth nothing, right? Well, how does that happen? One, fraud can happen. And when you get to an economy that's on the brink and public credit and bank credit starting to dry up, people are seeking yield. And it does lead to many more people cutting corners, committing fraud, turning what could have been good investments into Ponzi schemes because they're out of money and they're robbing Peter to pay Paul. And you start to see kind of this risk appetite grow for a while, which allows for fraud, false valuations of their assets and their company. And then it's like everything starts to squeeze and you start to see, as they say, the proverbial who's swimming naked. And so we've got that massive wall coming up right now. The economy's been struggling just long enough, and all these refis are coming up. And we know what the data is in the banking sector. We know what the data is in the commercial real estate sector, at least for bank loans and similar loans, Fannie Mae, Freddie Mac, government loans. The real issue, Michael, is private credit, again, is not regulated. It's not regulated by the FDIC, the US Treasury, the Federal Reserve. And so they don't even know how big it is. And they don't know if some of these loans, some of these companies have gotten multiple loans from multiple people on the same assets. And that's kind of the risk that we saw in the headlines was, hey, we had 3 major banks take a hit on the same collateral of one company that probably went to 3 lenders. But since it's not filed, it's not like you're buying a piece of real estate and it's filed with the courthouse. They don't know that these borrowers got loans from other people's. And so the market is very, very big, and we're coming up upon major refinance requirements, companies that cannot refinance. And the question is just how many are illiquid how many are insolvent, meaning the debt that they need to refi is higher than the current value of their company or the assets they're buying. And when it starts to hit and you start to take the losses, how big is that domino? How bad will it affect the private system, investors that are wiped out because they invested in a fund that is funding these things? They invested in an insurance company that funded these things. There's all kinds of private lenders that are institutions. And what we don't know is what's the level of systemic risk. We know there's systemic risk. The IMF is concerned that there's systemic risk. Jamie Dimon is concerned that there's systemic risk. Scott Bessent has said, hey, this is a concern of ours. Where is the risk and how big is it? The issue is there's no way to know with data how big it is and then to regulate it quickly enough. So the reality is, there's risk, and the risk is really coming to a head because we believe, just based on where interest rates were and lenders who have shown when they took loans, that this massive wall of refinance is coming due in major part in 2026 and 2027. And if we start to see defaults, Michael, not only could it potentially be as bad as like the great financial crisis, some are saying it could be. It depends on how bad the banks are hit. But generally, financial crises happen in cycles. And I'll kind of end with this and then we can open it up. So thank you for your patience. But credit cycles go just like the retail or business cycle, where we see peaks and troughs and we see expansions and contractions and recessions. Credit goes in cycles as well. Liquidity goes in cycles as well. And generally speaking, it used to be, hey, at the top of a business cycle, liquidity is easy. And when you hit a recession, the banks dry up and then it's hard to get credit. And then, that's why your recession lasts a little bit longer until things start to expand. The Fed cuts rates, pumps in money. But what we're kind of seeing now is this bit of a disconnect in the normal business cycle driving credit, because of the amount of liquidity that has been in the system and how much of it is private. And these cycles typically go about every 65 months, just over 5 years. Why is that? Because private lending and government lending on commercial assets and companies are every 5 years. So when you get to the end of the wall of maturity, when most loans were taken out when rates were low and now they're all coming up due, that's when you have this mismatch of the value of collateral to how much liquidity is out there. These lenders get really nervous. They're not going to give the loans to all the money that needs to be refinanced. And so now you have a major default of many different types of loans across the breadth of the economy that cannot be refinanced. You have a wave of defaults that creates fear for the banks, fear for the lenders, layoffs of the employees that are there, fear for the employees that are at the companies that are failing. And that high fear is what really creates that financial crisis. And so I'm really nervous about this. And like Jamie Dimon says, when you see one cockroach, there's usually a whole bunch more. We've only seen 2 really big ones in the headlines. But I think if you just look at commercial real estate and what's happening there, and you extrapolate that's happening to companies across the country for the same reason of needing to refinance at the time that there is tightening credit and tightening liquidity. That's when you really have, big fallout in the economy that could, push us over into a deep financial crisis if it materializes.
Yeah. So when I think about everything you've outlined there in private credit, it does rhyme with the GFC. Obviously, the asset is very different. Asset in the GFC was single family homes, residential loans. However, the refi pain is the same spark. It's the same match that sets this thing on fire, right? Because again, 50% of residential loans were ARMs in 06, which meant they all blew up in 08. It's predictable, right? It's this wave of maturities that force behavior and then cascading from there. So when I look at private credit, and again, it's $1.5 to $4 trillion. And then I step back and go, okay, what assets are in there? It definitely feels, you've nailed them both, but I just want to highlight them again. One is definitely going to be commercial real estate, right? We're seeing delinquencies at crazy levels. Office now is at a record like 12%, multifamilies at like 8.5%, right? These are not good numbers.
Worse than the GFC in terms of default.
Yep.
levels
Yep.
at this
And
point.
and getting worse, right? Not
Yes.
it hasn't rolled over yet.
Right.
The trend is still up. But where I think a lot of the pain is, and probably where the majority of the cockroaches are private enterprises, right? We loaded up on cheap debt. We
Yes.
collectively loaded up on cheap debt. And if you did that in private credit and you had 3 to 5 years, that wall of maturity is real. So when I play that out in my head, it's like, okay, we're just going to have a lot more companies, go poof, to your point, right? There will be more fraud, right? That's just what happens in this part of the cycle is you pledge assets to multiple banks because you're trying to survive and you go
Mhm.
boom. We're going to have plenty of write downs. And then I'm like, okay, how does that cascade to the banks? Because if it just stays in private credit land and, hedge funds and insurance companies and all of that, probably not too concerned. But when it rolls to the big banks and small and medium sized regional banks, that's where I get a little nervous, right? Because again,
Yeah.
that's where the Fed has to come in, Treasury has to come in. I don't know that if private credit stays out of the banking system in any great size, I don't know that they have to do anything. And then I step back and go, okay, how did we solve this last time? And whether we like it or not, last time it was solved right around the creation of TARP, right? I think it was
Yeah.
$790 billion.
Yes.
Basically, the Fed came and bought these assets and held to maturity and, oh, by the way, made money, right?
Yes.
TARP was profitable. So again, it's like, okay, we know the playbook. If this thing starts cascading, you can already predict what happens, right? That's kind of
Mhm.
how I look at these dominoes. Where am I off?
Yeah, no, I tend to agree with that. I think the only thing is, and again, this is just about recognizing where could there be risk in the system.
Sure.
And if it happens, so what? How does that impact me as an investor? Because
Mm-hmm.
we can look at all kinds of risks. And the question is, what's the probability of that risk? It might be pretty low, but we want to be able to say, is it probable enough that I'll give you an example, Michael,
Mm-hmm.
with these credit cycle issues. And there's a lot of psychology into the banking decisions
Sure.
that lenders make, especially when you talk about smaller banks, local regional banks. Those lending decisions are made by bank boards, and oftentimes they're more regulated. So even like
For sure.
these banks that a lot of real estate investors use to finance real estate. Most real estate is not done by the Chase and the Wells Fargos. They're lending on your primary house and maybe your second home, but
Mm-hmm.
most real estate investment loans are done at the small local to regional level. And so you've got to look at the reality. You mentioned history. It kind of rhymes, right? History
Yep.
rhymes. It doesn't repeat. It's never exactly the same thing, but there are certain cycles that do repeat. And some of that is based on psychology and the herd. And, if it's one cockroach, it's like, this didn't affect us. We're going to keep moving on. If it's
Yeah.
two cockroaches, this doesn't affect us. But I can guarantee you those small regional banks are going, wait a second.
Yeah.
How many of our loans that we lent to local investors and local companies did they lie about their asset value? We've
That's where this
extended and
becomes a problem is when it's
yes.
localized. Yes.
Yes. And when they then say, hey, we extended and pretended for our investors. And I mean, listen, I have conversations with my local and regional banks
Oh,
to
yeah.
say, hey,
Yeah.
I've got loans that are coming up for refi. I'm going to be concerned. I can pay them off. Thankfully, the leverage is low compared to the value of most of my properties that I have, smaller properties that are local, and I'm able to make those payments. But you bet I've had these conversations saying, are you going to make me, when the rate resets, reappraise those properties? Are you going to make me maintain the LTV in my loan covenants? Like the loan can never go above 75% of the asset value. Some of these banks are going to go, yeah, we're going to make you maintain it. Now they haven't for a while because they're like, hey, you're a great investor. You've
Right.
paid your mortgage faithfully. We have a great relationship. Just keep paying and we're good. Well, one of my banks just got absorbed by a larger regional bank. And their policies may not be quite as, hey, we like you on a handshake. Our board is making this decision to extend to pretend. And as the
That's what got
regulator,
Dave Ramsey. That's what got Dave Ramsey back in the day.
absolutely,
He had
absolutely.
all these loans and handshake
Yeah,
agreements, and then his bank got bought,
yeah.
and bingo bango. Yeah.
And these bank regulators are coming in now and they're starting to say, hey, what percentage of your assets are hold to maturity? Have you marked to market them? Why or why
Yeah.
not? And so these banks are starting to get pressure to make sure that their book is very solid, that the assets that they lend on, number one, are well diversified, but they have real good collateral. And so what I think happens, and again, this happens kind of in these liquidity and collateral mismatch cycles that happen about every 5.5 years, you get these lenders to go, oh, we're nervous. There's too many of these commercial real estate loans going bad. There's too many of these, private loans going bad. There's too many small businesses declaring bankruptcy. I mean, we're seeing it all over in my region, and we're a pretty robust region for a lot of diversity of different types of industries. But you see not only big companies declaring bankruptcy, big companies warning on profit misses, laying off, but you're starting to see a real uptick in small businesses starting to go under. And so as you start to see the pain of defaults and layoffs and missed earnings and income not sufficient to cover that debt, the banks start to get really, really nervous, and they see more than what the headline shows, because they know on the ground. It's kind of like the Fed's beige book, right? The beige book's like, let's talk to the businesses on the ground and see what's really going off. How many people are no longer funding? You look at, I think it was Harvard University, this big endowment of all this private money being put in, and they can't get them renewed. Like liquidity's going, hey, we're not going to keep, giving you money or lending you money when you're not bringing in enough income from tuition. So you're starting to see credit pull back in terms of, what they give to. You're starting to see companies that historically have lent and given philanthropically pull back, and companies are tight, banks are tight, lending is tight. And the reality is that lenders make money based on making enough money for the risk inherent in the system. So when risk goes up, Michael, and collateral starts to default and not have as good collateral quality, whether again, you're talking about a company or real estate, that's more risk to the system. And so then the lenders also, people really don't think about this, but they increase the spread above their benchmark lending rate to require a higher interest rate on that debt for that risk. So not only do you have collateral that needs to be refinanced, companies that are failing, some, fraud and different things happening, and a threat that interest rates could go back up, all those things mean risk. And all those things mean that new loan that you're refinancing, I'll give you an example. I have several loans that are at 3.75 to 3.95 commercial real estate, small.
Yep.
They're going to refinance. I have one next month and then a few next year. If I'm lucky and if rates were to stay where they are today at about 7, so almost 7.25, almost double, right, where my interest rate is. So if my properties weren't creating enough income, the difference in that payment would be insurmountable. Thankfully, I've had a lot of these properties a long time. I've got a lot of good equity. I've got really good market rents. And so I'm able to absorb that higher cost. But the reality is many, many, many companies cannot, and especially in the private credit markets and these loans given to small businesses by regional banks. So I think there's more risk that it does hit the banking system than what you think there is, but not necessarily in really large banks. The really large banks, the Chases, the Wells Fargos, they'll pull out of this just fine, right? They've got so many other profit centers, but it's these smaller banks that I think really can start to fail. And once that domino hits, history repeats itself. There's a great book. I haven't finished it, but I'm reading it, and I've been following a lot of his work. His name is Michael Howell, and he has a book called Capital Wars. And it basically talks about these liquidity cycles and how they work, what happens in history. And he believes that we're really at the tail end of, liquidity being available, lots of liquidity and money in the system. We're starting to really see pullbacks. We're seeing an increase in these spreads demanded in order to give these loans. And we're starting to see a lot of lenders pull back. So he believes, based on, the cycles match up really well with history, we're falling, and this liquidity crisis potentially could hit first quarter, second quarter of 2026 or sooner. So if you have debt to refinance, here's the so what, right? If you're an investor and you're going, okay, Anna, the sky could fall. And what does that mean to me if it does? And what if the sky doesn't fall, but we just have a standard vanilla liquidity cycle hit where you've got a wall of stuff that has to be refinanced while credit's tightening a little bit. That's happening. It's already, it's in the data. So even if you just have a vanilla liquidity mismatch, when you need to refinance properties, the question is, are you going to be able to? And so, if you've got loans coming due February, March, mid to late next year, and your small bank says, you know what, we're not going to make that exception for you to allow your LTV to be a little higher. We're not going to make that exception to allow your debt coverage ratio to be lower than what it should be. Meaning, once we give you a loan, that payment has to be no more than 90% of what you bring in cash net before the payment. So they have those threshold measures. They might say, you know what, we're not comfortable with refinancing this. You're going to have to go find another lender. The issue is, are you going to be able to find another small lender if they're in this liquidity cycle crunch? If they've got other debt that's defaulting, you might have a really hard time refinancing your debt. And so you've got to be thinking about these things. If rates fall, great. But if rates end up ticking up, if treasuries go up, even though the Fed cuts rates, that could really impact the rate at which you can refinance. And a lot of lenders start to pull down their LTV. And we've already seen this, Michael. So don't think that because you got a loan at 80% LTV, when you want to go refinance it in good times, you can get a new loan at 80% LTV at whatever new rate. But when there is a liquidity mismatch cycle crunch and it hits its head, you're going to have lenders that say, you know what, we'll give you a loan for 65% of your current value, which is less than the value that it was when you got a 75, 80% LTV. And therefore, we'll refinance you out of that loan, but you got to come to the table with $1 million for us to do it. You got to pay down the loan. We're giving you less loan than what your current loan is. And most investors can't absorb that. So that's the so what. You've got to look ahead and say, what do I have coming due? And if I need to refinance in the next year, I better be paying attention to this, because I better be talking to my banks and maybe even refinancing a little bit early. Maybe you refinance now when rates are cut and don't assume we're going to get a December rate cut, rates are going to go down. Maybe you take your chances and you wait till January. But if we're coming up to this cycle mismatch and a potential liquidity crisis, it's going to be really hard for you to refinance potentially next year. And a lot of this is because of what's happening in private credit, not so much just where are we in the economic cycle and are we in a recession? What does the Fed do with rates? This credit cycle is much bigger and much more important to you as an investor than these headline things that we talk about every day.
Anna, where can people find you?
You can find me on social media, Anna Kelly, REI Mom, here on your show, and for real estate and wealth coaching and consulting at AnnaKellyInvesting.com.
Thank you so much.